Okay, this lecture 3, and continuing on to business about risk. And remember, when we finished the last one, we said that there were total risk, which is what a firm sees. There's a unique part, which is peculiar to that firm, plus market risk, the level that raises all boats or sinks them, as the case may be. Now, I want to sort of draw a semi-financial picture of a firm. And over here, of course, we have management. And these are really where the assets are. People, although they don't formally put people on the balance sheet. That's always been an interesting accounting situation. Everybody knows the people are the most valuable assets in a company, and yet there seems to be no way to put them on the balance sheet as far as accounting goes. Over here you have the financing. Now, debt and equity, sure. Now, here, the folks that are dealing with this are playing in a capital market. I'll make it plural because they're all over the world. And the thing I want to point out about that is these are very efficient markets. Now, there's all sorts of theses and part about whether it's strong, weak, or semi-strong efficiency and so forth. But I think from our purposes right now, all that you need to know is that information in here travels very quickly. People are doing all sorts of things to get better and better information. And the thing I always like is the fact that I can go out and buy a share of stock and pay a commission that's fairly close to the percentage that a big market player would pay. Now, on this side, what we really have are the product services market. And that's where all the firms play. And these markets, by and large, are very inefficient. And by that I mean that there's a lot of proprietary information. You can develop competitive advantage. You can do things because of your experience or your particular skills that other firms can't do. And this gives you the ability to develop pricing power and sorts of thing and get some excess returns, if you will, which really means that you can invest money and build assets and build capabilities where the future returns are greater than the cost. Another way to say that is the net present value can be greater than zero. And that's what you look for. That's what they look for, projects net present value greater than zero. If I come over here, really almost all that's available to you are net present value equal to zero. In fact, I'm sure you've heard that professional money managers do not outperform the indexes. And that's pretty much true once you take commissions into account. Now, there are a couple of places here, though, I just like to mention where you can beat the market. And that's if you have superior information. But you need more than just superior information, because if you don't share it with anybody, it doesn't do you any good. But eventually, if you share it with other people, then hopefully others will value it also, the other market players. So if the others value your information and you have it before they do, you can make a lot of money in the markets. And that's why insider trading is illegal and so forth and so on. Now, let's get back to the markets over here. Here's where a firm can create value. And we'll talk about that in a little bit more in the future. And what's really important, sustainable competitive advantage. Now, you can't really do that over here. Now, maybe you can develop some nifty way of analyzing things and so forth, but I would be very suspicious if somebody just used analysis to say, I'm a better analyzer so I can make you all out of money. Where you can get this would be for, I don't know if I said this, but where you knew the firm, say it was a drug firm, and you knew that the FDA was going to give them an okay next week, so you can trade, you could go and buy that stock now, and the other people find it out and they do real well. So there are a bunch of examples like that. But with the world out there, with all the information flowing, it's very, very hard to get. Okay, now if you look at the influence is high here. You have huge influence, high influence. Here it's low. You don't have much influence in that market. But the other distinguishing thing is, over here you can buy and sell in minutes. Over here, it's a year thing. I think the average time to build a plant and have it come online is 3 or 4 years, and you really don't know until the products start running through it and people start selling it and so forth, if in fact you have been able to actually execute this net present value equals zero strategy. So the whole point of this, though, and this is what I want to get to. Oh, by the way, let me mention something else while we've got this here. And that is that most of the things that you learn in MBA school or when you read finance books, they assume that this side and this side are separate. And that really means if you come up with a strategy over here, you can finance it. It's just a question of cost. Well, I think they found out in recent times that that's not true. And that leads to all sorts of liquidity problems. But this has been pretty much ignored by people who say, well, if you can find a net present value greater than zero product, hey, maybe we can finance it. Well, not anymore. Now, hopefully it'll get back to so that's pretty much true, but it's certainly not true right now. What I want to sort of take from this is a couple of things. One is firms should not diversify. Now you might say, wait a minute, everything I've learned from all the investment professionals and things is it's really good to diversify your portfolio because that's how you, maybe you don't want to go completely to just the market, but you can still keep a pretty diversified portfolio and gain a little bit of return. And so how come it's not good for a firm? Well, the reason is that shareholders can do it so much more cheaply than you can. And so to diversify just to get into, another line of business doesn't really work very well. And in fact, the history has been that if you look at the large horizontally integrated firms, once you break them up, the value of the pieces is more than the original company stood for. So there you could see that management, by keeping these firms under one roof, was creating a negative to the shareholder value or value of the firm. So you don't want to diversify. Now, it turns out, though, you might be able to do it. Let's say you know about a firm or decide to buy a privately held firm. It doesn't have a public market, and it makes a product that is really key, fits right into what you're doing. But other players in the capital market can't do that because they don't have access. There's no other public firms that can do that. So therefore you can do it and diversify and increase your returns cheaper than the marketplace. But that's rare. It has to be something like that. Now the other thing is that value is created, and we haven't defined that yet, but one way to think about it is that that's how you keep your stock price up. But value is created on the left-hand side. Left-hand side of the balance sheet. That's where the assets are. Here. That's where you spend your time. Develop new assets, finance them, and look for these net present value greater than zero products. That's where the action is. Okay, we're running out of time for this one, so when we start on 4, we'll add some more numbers here onto this truths and things that are consequences of this.